All right, everyone, listen up. Today, we are going to talk about something very important. We are going to talk about your money. More specifically, we are going to talk about how to make your money work for you. You work hard for every single dollar, don't you? Many of you hear the word investing and you get scared. You think it is too complicated. You think it is too risky. You think it is something only for the very wealthy. I am here to tell you that is a big, fat denial. You can do this. You must do this. And one of the simplest, smartest ways to get started is with something called an ETF. Think of this conversation as your first step onto a path of financial empowerment. You are taking control. You are saying, my future matters and I am going to build it. For too long, people have been intimidated by Wall Street jargon and confusing charts. We are going to cut through all of that noise. I want to give you the knowledge and the confidence to make smart decisions. Exchange-traded funds, or ETFs, are a fantastic tool that can help you do just that. They are accessible, they are understandable, and they can help you build wealth over time. Let's break it down. So, what in the world is an ETF? Let's put it in simple terms you can understand. An exchange-traded fund is like a basket. Now imagine you want to buy some fruit. You could go and buy one apple, then one orange, then one banana one by one. That takes time and effort. Or you could buy a pre-packaged fruit basket that already has a variety of fruits inside it. An ETF is that fruit basket. Instead of holding different fruits, it holds a collection of different investments like stocks, bonds, commodities. When you buy one share of an ETF, you are buying a small piece of every single investment inside that basket. It is that simple. The beauty of this basket approach is diversification. Now that is a $5 word, but the concept is simple. It means not putting all your eggs in one basket. If you only own stock in one company, let's say a company that makes umbrellas, and there is a long, sunny drought, what happens to your investment? It goes down, right? But if your basket, your ETF, also holds shares in companies that make sunscreen, sunglasses, and ice cream, then the success of those companies can help balance out the poor performance of the umbrella company. Another key part of an ETF is in its name, exchange traded. This just means it trades on a stock exchange just like a regular stock. ETFs work the exact same way. When you first look up an ETF, you will see a bunch of information that might look like a foreign language, but I promise you, it is not. Let's crack this code together. The first thing you will always see is the ticker symbol. This is a short, unique code of letters used to identify the ETF on the stock exchange. For example, an ETF that tracks the SP 500 index might have a ticker like SPY-VO. Think of it as the ETF's nickname. You use this ticker to look up its price, get more information, and to actually buy or sell it in your brokerage account. It is your starting point for everything. Next, you will see information about what the ETF actually invests in. This is often broken down by sector holdings. The sector tells you the industries the ETF is focused on. Is it technology, healthcare, finance, or energy? A broad market ETF will have a mix of all sectors. The holdings list is the most important part. This shows you the actual companies or bonds inside the ETF's basket. You should always look at the top 10 holdings: Apple, Microsoft, Amazon. That indicates it's heavily invested in large US tech companies. Then we have a very, very important number you must pay attention to. It is called the expense ratio. Now listen closely. Nothing in life is free, and that includes managing an ETF. The expense ratio is the small annual fee the fund company charges to operate the ETF. It is expressed as a percentage of your investment. For example, an expense ratio of 0.03% means you pay just $30 for every $1,000 you have invested per year. You want this number to be as low as possible. Section 4, ETFs versus stocks versus mutual funds. The key differences. Now, you might be thinking, Suze, this sounds a little like a stock, but also a little like a mutual fund. You are exactly right, but there are critical differences you need to understand. Let's start with stocks. When you buy a stock, you are buying a share of ownership in one single company, just one. All your risk and potential reward are tied to the success or failure of that individual business. If the company does fantastically well, you could see huge gains. But if that company gets into trouble, your investment could lose a significant amount of value or even become worthless. Now let's talk about traditional mutual funds. Like ETFs, mutual funds are also baskets of investments that hold many stocks, bonds. However, the key difference is how they are traded. You can only buy or sell a mutual fund once per day after the market closes at a price called the net asset value, or NAV. You don't know the exact price you will pay or receive when you place your order during the day. ETFs take the best features of both worlds and combine them. Like a mutual fund, an ETF offers instant diversification by holding a basket of many different securities. But, like a stock, an ETF trades on an exchange all day long. You can see its price change from minute to minute, and you can buy or sell it whenever the market is open. This gives you transparency and control over the price you pay. So, let's put it all together. A stock is a piece of one company. A mutual fund is a diversified basket of many companies, but it only trades once a day and often has higher fees. An ETF is also a diversified basket of many companies, but it trades like a stock all day long and typically has very low expense ratios. For most beginners, the combination of low-cost diversification and trading flexibility makes ETFs the superior choice. It is a modern, efficient, and democratic way to invest. Section 5. A real-world example. Let's read an ETF profile together. Okay, theory is nice, but let's get practical. Let's pretend we are looking up a real ETF profile right now. We are going to look at one of the most popular types of ETFs, one that tracks the entire US stock market. Let's use the Vanguard Total Stock Market ETF as our example. The first thing we look for is its ticker symbol, which is VTI. If we type VTI into any financial website or our brokerage account, its profile will pop right up. We immediately see its current price. Let's say it's $270 per share. This tells us the cost to buy one share, one basket of the entire US stock market. Now we scroll down to look at its holdings. What is inside this VTI basket? The profile will show us that it holds thousands of stocks, over 3,700 of them. This is incredible diversification. We look at the top 10 holdings to get a feel for its biggest positions: Microsoft, Apple, Nvidia, Amazon, Google, or Alphabet. This tells us that while it holds the whole market, it is weighted towards the largest and most successful companies in America. We can also look at the sector breakdown and see it has a healthy mix, around 30% in technology, 13% in financials, 12% in healthcare, and so on. Next, we must find that all-important number, the expense ratio. For VTI, we would find that its expense ratio is an incredibly low 0.03%. Let me repeat that, 0.03%. It means for every $10,000 you invest in VTI, you are only paying a fee of $3 per year to the fund company. This is practically nothing. Compare that to some mutual funds that can charge 1% or more, which would be $100 on that same $10,000. Keeping your fees this low is one of the single most important things you can do to maximize your long-term returns. It is a non-negotiable rule. Section 6. Your Smart Start. Tips for choosing your first ETF. You are feeling confident, you understand the basics, and now you are ready to choose your first ETF. That is fantastic. But with thousands of ETFs out there, where do you begin? My first and most important tip is to start simple and broad. Do not get fancy. Do not try to pick some obscure niche ETF that focuses only on robotics in one specific country. For your first investment, you should consider a broad market index ETF. These are ETFs that track a major, well-known index like the S&P 500. My second tip is to always check the expense ratio. This should be a primary factor in your decision. When comparing two similar ETFs that both track the S&P 500, choose the one with the lower expense ratio. Over decades of investing, even a small difference in fees can add up. That can mean tens of thousands of dollars that stay in your account, not the fund companies. Third, understand what you own. This goes back to looking at the holdings and sectors. Before you click buy, have a basic understanding of what's inside the ETF. Technology-focused ETF? Your returns will be tied to the tech industry's fortunes. International ETF? Expect currency exposure and foreign economic risk. Do not buy an ETF because its ticker sounds cool. Do not buy it just because someone mentioned it on social media. Do your own simple 5-minute homework. Finally, think about your personal goals and risk tolerance. We have covered a lot of ground today, and I want you to feel proud of yourself. You have taken a huge step towards securing your financial future. You have learned what an ETF is, a simple basket of investments. You have learned how to read its profile, ticker symbol, expense ratio. You understand how ETFs give you the diversification of a mutual fund with the flexibility of a stock. Most importantly, you now have the knowledge to cut through the noise and make an informed decision. You are no longer on the sidelines of your own financial life. You are in the driver's seat, and you are ready to move forward with confidence. Investing is not about being a genius or timing the market perfectly. It is about discipline, patience, and consistency. It is about developing smart habits, the habit of saving a portion of every paycheck, the habit of investing that money regularly, whether the market is up or down. By choosing a low-cost, diversified ETF, you are setting yourself up with a powerful tool to build wealth over the long term. Do not stop here. Your financial education is a lifelong journey. Keep reading, keep learning, keep asking questions, but do not fall into the trap of analysis paralysis, where you are too afraid to start because you feel you do not know enough. You know enough right now to begin. You can start small. You can open a brokerage account today and invest your first $100 into a broad market ETF. The most important thing is to start. I want you to remember this. You are strong, you are smart, you are capable of building the future you deserve.